Welcome, Wealth Advocates Nation. It's great to be back to you live from Wealth Advocates Global Headquarters. What an exciting day. I am here with these two fine gentlemen, really the geniuses of Wealth Advocates, right here to my left and to my right. Brad Harsh, our Director of Trading. He's the guy behind the strategies. And this is where we give the input to, and we have lots of strategy meetings on investments. Brad, thanks for coming all the way from Sacramento, California.
Good to be here.
To Wealth Advocates International Headquarters. And of course, I have the man, the myth, the legend, John Mickelson, great financial advisor. We're excited to have both of you with me today so we can talk about 2025 and what's going on in the economy in 2025. You know, before we jump into it, let's pause for a second and say how grateful we are for our clients. We love educated clients. We want clients to know what's going on, and so they know educated questions to ask, because we want to have deep dive conversations into your portfolios, your investments, and really it's about reaching your financial goal. Wealth Advocates has a unique value proposition, I think different than any other financial advising firm. We look at everything through 5 lenses. The first lens is your investment plan. The second is your income plan. The third is your tax plan, then your insurance plan, and finally your estate plan. Why do we do this? This is that old song, the knee bone's connected to the shin bone, which is connected to the ankle bone, connected to the foot bone. If one of those is out of whack, everything's out of whack. You have a hurt knee, all of a sudden your back starts hurting. The same thing with your income plan, your tax plan, your investment plan, your insurance plan, your estate plan. They all have to be working in concert. And if they're not aligned, well, something won't happen correctly. Therefore, you're less likely to hit your financial goals. So we're going to talk about each of those individually in concert as we look toward 2025. So let's start with you, Brad.
Yes.
2024 was a fantastic year. It's on the back of another great year, 2023.
That's correct.
Give us some insight on what's going on in the market right now.
Well, what's right now is we're coming off of the first part, the investment plan. 2024 was a great year. In retrospect, we can look back and we can think the market did phenomenally well. Most major indexes were up rather significantly, but it didn't feel like that at many times through 2024. There were downturns, and going through 2025 forward, we're already seeing the same sort of experience. We're optimistic for this year, but we can expect a little bit of a bumpy ride this year, and we intend to take full advantage of it.
For sure. It was not a straight line trajectory up and to the right. It always goes to the right, but not necessarily always up. In fact, there were probably 4 different inflection points. The end of the quarter seemed a little rough, November and December.
It did. It did. And then it started, and then it finished strong. But I found it was really interesting that through the mid-year, we had 3 different periods of time where there was a good 8% pullback in the general market. Those never feel good.
No.
But the fact is, it's been a really resilient economy and a really resilient market.
Yeah, looking back at 2024, I think generally speaking, it was a good year for all investors. We're going to talk a little bit about the Fed's target.
Yep.
They want to hit a 2% inflation index. They're not there yet, but it's huge progress from where we were. We ought to give some homage to that. Interest rate cuts. We had 3 of them in 2024. We ought to talk about that a little bit, but definitely some volatility, right?
Absolutely some volatility, and we can expect to see a little bit more of that. I think there's a lot of mixed blessings that we're seeing. We're surrounded by innovation. Yet anytime you have a political change, an administration change, changes in how economic and financial and fiscal policies are perceived and approached, we're right in the midst of that, and it's likely going to continue with a fair amount of volatility.
Really great and astute points right there.
I'm going to add to that is in that all that chaos of change, I think that we have to realize our human nature is to get caught up in the moment instead of the perspective. I think that we've seen a lot of change, and a lot of it does have impacts in the market temporarily. What we want to know is what's going to have long-term impact. The emotion will fade and real numbers come out, and then the market will equilibrate back to where it's supposed to be. So I think it's important to, with all this change that's happening, how much is real, how much is just emotional, what might happen, and not knowing what's really going to happen.
Very good point.
The market is the thermostat of the engine of the economy. It is not the engine of the economy. Those small businesses are the engine of the economy.
Yeah.
But one of the touch points of that engine is interest rates. It's a hot topic right now. We talk about it a lot. The Fed has intention of cutting rates this year. And when we talk about rates, everybody gravitates toward mortgages. They know what mortgage rates are, probably more so than they ever have before. And underneath, and the driver behind mortgage rates are the Fed Reserve rates.
Right.
Is it really high? Is it really hot? Maybe not necessarily. Let me give you some relative points to kind of keep that conversation going. If you look at where we're at right now, the Fed fund rate is between 4.25 and 4.5%, right? Well, we just came off of really two periods of zero. They were zero between 20 and 2022, COVID years. They were zero between 2016 and 2009. You know, that was the back of the Great Recession, right?
That's correct.
They climbed a little bit between 2016 and 2020 to maybe, let's call it 2.5%. Prior to the Great Recession, 2004 to 2008, we saw them at 5.5%. Before that, it was at 6.5%. So that 4.25%, 4.5%, that's not so bad, is it?
Historically, it's not. I mean, but we don't feel that way because we, for a little while, got really used to 3% money.
Yes.
And that is not really, in historical sense, that's really, really low.
It is really low. In fact, those Social Security recipients whose whose income is increased based on the Consumer Price Index, and we're going to come back to that in a second, they didn't get a single raise for multiple years in a row. And so you're right, that isn't healthy. It hurts our seniors.
And it's important to realize that when rates go down that low, it allows us to raise price on the other side. I mean, housing is a great example of that. You look at what happened to housing when 3% money existed, it went crazy. And at some point when the rates come up, you can't afford to pay all that interest and the raise in the cost of the home at the same time. You can't do it. It won't. So at some point it comes back to what will incomes allow? What can people afford to pay?
Absolutely. And the thing is, when we talk about things like the Fed funds rate, interest rates, mortgage rates, again, being the best visual indicator for all of our clients, we got to remember that the Fed's job is to control the monetary supply. And it's a lot like the tail wagging the dog. So all of us out here in the real world are living our lives and are adjusting to interest rates and the economy and prices and everything else. And the Fed is simply adjusting these interest rates based upon how good or bad or robust the economy and economic activity is at the time. So
give us the real data points on inflation. What do you have?
The real data points on inflation is that we've seen a nice gradual drift downward. The Fed has done a highly capable job, I think, of not only controlling inflation, but allowing it to ease and to settle it to where it belongs. I think they've got a tough job ahead of them because of the fact that as we see all these economic and fiscal policy changes, some are very exciting to watch and some are very confusing to watch. We are likely to see more and more conversations about potential inflation increases and potential recessionary concerns. That's going to naturally cause the Fed to want to push interest rates higher to slow down any economic factors that get too far ahead of themselves.
John, inflation, talk to us about unemployment and how that's impacting inflation.
Yeah. Unemployment's an interesting one because it has actually been really low for a long time. And we're at, the participation rate's actually pretty high.
Oh, for sure.
So the hard part of that is,
isn't that right?
Yeah,
That's beyond full employment.
Yeah. And so that's a hard thing when there's that much inflation, especially when what we have seen is what we mentioned before, prices rise, but wages have not risen as fast nationally. Now, local economy, it's actually risen a fair amount the last year or so. But again, when prices rise and incomes stay flat, that's where people start to feel a squeeze. And one of the interesting indicators is just in the last 3 months, the number of defaults or credit card defaults has risen dramatically. That's a pretty good indicator that people's incomes are starting to get squeezed more and more, which may push for raising incomes a little bit.
So inflation peaks June of 2022, I believe, right? We're targeting. We really want to get to 2%. That's astounding. We're down at 3.9%, I believe. Is that our number right now? Yep. We're adding 250,000 jobs every single quarter. Crazy.
Right.
I mean, more jobs than there are workers. We are beyond full employment. wages are going to have to offset, and that's going to increase interest rates. So Brad, I need some detail on the balance between interest rates and the price of bonds, because a lot of our senior investors want to be in bonds. That's a safe haven. It's also a tax haven. Tell us about interest rates and bonds.
Yeah, perfect time to bring it up. And this is my one visual example for the day.
Oh, good.
As
Zoom on this guy doing the teeter-totter.
As interest
A little bit
rates
of a
in the
dance.
general market move higher, the price of bonds on the other side moves lower, much like a teeter-totter we would see on the playground. As interest rates gradually decline, the price of the bonds generally increase. And it's a very simple, straightforward relationship, but it has massive implications for what we're seeing now. If we see interest rates start to push up, we could expect the price of bonds to drop. So we need to keep that on our radar. I know from a strategy perspective, which we may talk about a little bit more in a little bit, but from a strategy perspective, we're taking some measures to start to protect against potential bond price decrease in certain areas.
So this is a wonderful time. John, give us a little insight on inverted yield curves, because we just barely came off of high interest rates, and Brad just explained how that impacts bonds.
Yeah.
Now we're moving down toward low interest rates. I think it's back in check, but just for a definition standpoint, where are we?
And many know what this is, many don't, but inverted yield curve just means I can make money short term more than I can make money long term. And of course, who would go and invest money for 5 years and earn less than what they could do if they could do it for a year? That's the inverted yield curve, is when short-term rates are better than long-term rates. And that's usually an indication, at least in history, it's been an indication of a looming, downturn in the economy.
Mm-hmm.
With what's happened, they've kind of staved that off, and we're starting to now see a normal yield curve where we see short-term rates are lower than the long-term rates.
But how great was it that we could see these money markets yielding 5.25%? Wasn't that the best thing in the world? It's not there anymore
for cash.
Well, and it was a great thing. An expression we used back in the trading area is that the stock market screams and the bond market whispers. And so when we got an inverted yield curve, the whispers that we need to hear is that when short-term money is cheaper, that gives us a sign of where the market thinks interest rates are going. Mm-hmm. And so if we now are starting to see a more normalized, a more regularly sloped yield curve, then that just means that the market perception towards interest rates and the direction of interest rates is shifting along with it.
In that vein, that's a great conversation point, an inflection point to talk a little bit about the cost of safety, because the gravitational pull, at least recently, has been, why do I need to roll the dice when I can get a 5% money market account? In fact, I have a lot of people that have done that. Let's just put it all on a money market because I can change it tomorrow. But while I just sit there, I think today I'm still earning like 4.2%, right, in a money market account.
Absolutely. And for all practical purposes, that is considered a safe rate of return. But we got to look a little deeper into the real meaning of safety. So on one hand, when we are in fearful situations, safety could imply that I want to put X amount of dollars in this account and I don't want it to go down 1 cent. That's a definition of safety. In another perspective, a definition of safety might be, well, my money needs to retain its purchasing power. My money needs to actually be able to take care of me 20 years from now or 10 years from now, as well as it is today. And so there's this shift between this definition of what each of us individually.
Well, we saw that last year, especially when we said, hey, we're earning 5%, but what was inflation? I mean, it was higher, much higher than that.
At 1.8
So
or 9%.
were we safe? Were
Depends
we
on
really
what
safe
date
at 5?
you said, but we were at 5, we were at 4, now we're at 3.9.
So, when you say safety, that can be a lot of different things.
And when we see major stock market indexes doing 15 and 18 and 20% or more in a given year, then we think, well, am I really safe at 5% when I'm missing out on these other returns elsewhere?
Okay, so great turning point here. You talked about we had 2 good years. 2023, great year. 2024, great year. The cost of safety, getting into that. Right now, as we jump into 2025, and Brad, I want you to talk about 2025. We're looking at interest rate cuts. We hope they were just deferred, right? We're looking at inflation. We're looking at a brand new administration introducing more executive orders than we've ever seen before in 6 weeks,
Right.
in 4 weeks. We're 4 weeks into this right now as this recording. And then we're looking at all kinds of global conflict, not just wars, but also economic conflict.
Right.
Tariffs. I just said the tariff word. So let's talk. Let's start with the Fed. What's going to happen with the Fed?
Okay, this is my opinion. I'm hopeful that the Fed is going to follow through on the comments that have been made in the last 2 or 3 Fed meetings, that they can see future interest rate cuts. What I'm starting to see is less and less evidence that might support those continued cuts.
Yeah.
So we could certainly see an interest rate cut, and I hope we do. I rather enjoy them. Yet, on the other hand, I don't know that the Fed, being that its job is to be the calm in the midst of a storm, is going to have the hard data that's going to support that. If anything, I think interest rates will stay stable. Later on in the year, we could even see interest rates rise if indeed all of the aftermath or the effects of the tariffs or the policy changes or the executive orders or whatever it is that we happen to be staring at it at that particular time, if it really materializes in some inflationary pressures.
So 8 Fed meetings this year,
Correct?
projected two more rate cuts, right?
Yeah.
Right?
Yeah.
John, what is the purpose of the Fed there?
Oh, that is a good question.
Well, I have it written on the slide right in front of you. Just read the slide.
Yeah, I know. Their objective is to get to inflation at a normal rate and full employment.
Right.
That's really what they're about.
Okay, now
Now-
editorialize.
Yeah. My opinion in it is that, at some point you have to realize that the market you can't just stave off every downturn that happens.
Right.
I mean, if history has taught us one thing, is we see a lot more ups, but we still see the downs, and they're going to happen. They're healthy. They're normal. I mean, so, at some point we will see a pullback. Now, do I think it's this year? I don't know. I doubt it, but we don't know that. I mean, especially with all the things that are happening and all the changes that are taking place. Now, to clients, what that means to me is, how do we plan around that? Well, appropriate risk management. And we've talked about that, but when it comes down to a personal individual sitting in front of me, it's, do you have the right money in the right places?
Yes.
If we know there's going to be a downturn at some point, do you have enough to weather that storm? Knowing that they usually don't last more than a year or two, if that.
So, Brad, let's put all those data points together that John just so well articulated. So the stated intent is for 2 rate cuts, inflation, all these new jobs coming online. The gravitational pull by the Fed is we don't want to do any rate cuts. In fact, they've deferred the rate cuts.
Yeah.
What is going to happen?
If you ask, I'm going to give you my straight opinion.
Oh, good.
I think we're going to see 1 rate cut for the remainder
We
of the
hate
year.
liars. So good. Okay. 1 rate cut, huh?
Yeah, so we're going to see 1 rate cut for the end of the year, or through the end of the year. If we get 2, that's fantastic. But the Fed has got to act like the level head of the economy, and there's a lot of things that fiscally are really exciting to a lot of people, where the implication, the tariffs sound like a great idea to make other countries pay their fair share. And to reciprocate for the trade policies between our companies. That's I get it. I understand that. There might be an aftermath of that and a shoe. So we're prepared for 1 rate cut. We're prepared for rising inflation. We're prepared for a couple of 10%-ish pullbacks in the market. We're in the midst of one right now, possibly.
Okay, so with 3 rate cuts as our backdrop heading into 2025, and some projected ones, but skeptically projected, right?
Yes.
Are stocks too expensive now?
Great question, because while on one hand, we've got a somewhat cautionary tone about whether there's going to be 1 or more rate cuts through the end of the year and what inflation is going to look like, the fact is, I think that right now is an amazing investment environment, because despite the economic challenges, we are surrounded by innovation.
Yeah,
We're surrounded by absolute transformation across industries. And we're watching 3 key areas where we think that the Standard & Poor's 500 index is going to go through some ups and downs, but we're looking for a target price of $66.99 by the end of the year.
Great point, Brad. I mean, the economy is changing right before our eyes, whether it's tariffs, whether it's innovation, whether it's AI, hot topic right now, cryptocurrency, right? I have clients come in and all the time and say, hey, I want cryptocurrency. And I said, okay, 2 rules to that. 1, why do you want cryptocurrency? And 2, tell me what cryptocurrency is. If you can't tell me those, we're not doing it. But the point of this is we are a resource to explain how these things operate. And we're talking in broad terms to everybody listening, and there are going to be a lot of downloads of this podcast. I can't speak to your individual situation. So guess what? Come on in. Let's sit down. Let's chat. I want to help you through and educate you how all these modifications in the economy, tariffs, cryptocurrency, how they may impact your portfolio. So let's book some time and visit together. Okay, let's talk about the outlook on the stocks. We talked a little bit about how maybe they're too expensive, how maybe it's the best time in the world to invest. What's the long-term strategy?
The long-term strategy is to seek the right mix of investments for the individual client situation. Now, within the broad answer I just gave of seeking the right mix, from a strategy perspective, we can't help but ignore the massive amount of innovation that's happening in 3 key sectors: healthcare technology, robotics and artificial intelligence, and clean energy and storage. So those 3 areas are essentially driving each other as well as growing big on their own. So we would like to see a broad mix. I think that this blend of, or this influx of innovation mixed in with some of the uncertainties of what we're seeing politically and economically and fiscally as a country, I really am bullish on the future. Not without its hiccups, not without its setbacks periodically, but highly bullish.
John, you're a smart guy, master's degree of financial planning. Yesterday's lead CNBC story said something to the tune of, and it has a picture of a mountain, from the top, it sure is a scary fall. Is there a potential for a correction?
Absolutely.
And will you define what a correction is, by the way?
Well, correction's 10% or more, right?
Yep.
So is there
all-time highs?
Yeah. Wait, look how much we've gained in 2 years.
For sure.
Now, granted, back it up one more year. Go to 2022.
Look how much we lost.
2022 was the year when inflation hit all the companies, and they were like, "Oh my gosh, all my costs are twice as much."
And correct me if I'm wrong,
profits
Brad,
are
it
gone.
wasn't until October that we actually broke even from the top of 2022. Is that
Yeah.
right?
That is correct.
Okay, carry on.
So we see this downturn initially, and then a big upswing. The biggest thing is, and again, this goes back to one of the things I said before, is maintaining a perspective that is long enough. We see short term. In fact, my favorite example, my dad, when he was alive, he had a little bit of dementia. We would have 4 good days in a row and then 1 down day. And he'd call me. And all I could remember was the day we were in, the 1 down
I think
day.
everybody I know has
He'd say,
dementia.
John, are we okay? And I'd say, Dad, tell you what, how about if I double what I put in your bank account every single month? And he'd look at me and goes, well, I don't need that. And I say, I know, but I want you to know I can do it.
Yeah.
And so I think that we do the same thing. We're just in a broader perspective, is we lose sight of the fact that, it doesn't take a genius to see the market grows over time because people buy their groceries. Good times are bad. They fill their cars with gas. They go on vacation once in a while. Kids grow up. They buy cars. They buy houses. The economy is going to evolve and expand, especially with all the innovation. Yes, it's going to grow in the short term. Is it going to be fluctuating? Yes. And you can't get panicked at every single downturn like my dad. It's so important for us to realize we are going to see volatility. It is part of the game.
And we can even say, albeit painful, albeit scary, those pullbacks, those corrections, they're a gift. They are necessary.
Buying opportunities.
And fortune favors the properly prepared. So if we as a crew together are able to help our clients be properly prepared at any one given moment, then we're best able to take advantage of those corrections that'll turn into bigger gains in the future.
Well, and I think our role is to make sure that we are looking at it from the logical standpoint and not the emotional standpoint.
No
Emotions are poison when it comes to the market. The logic that we take and saying, I understand, it doesn't mean we hold anything. It means we change when we know there's a need to change, but don't move out of those areas. Take advantage of the swings that we see.
No doubt.
We have been richly fed, as they say at church. I'm here with these 2 geniuses. We've walked away with a lot of great data points. Let me just share the notes that I've captured from both of your great insight. 1, inflation's still a factor. That's a big deal for us. Interest rates, they may stagnate. We may actually get a rate cut, but maybe not. Maybe not. The economy is still growing. So there's lots of buying opportunities out there, is what I heard you say, Brad.
Correct.
Volatility still causes concerns. That's what I heard from you, John. and proactive planning is really the key to working through all this.
Yeah.
Is that right?
Yeah.
That's absolutely
Okay,
correct.
great. Hey, I'm Patrick Jenkins here with John Mickelson and Brad Harsh, and we have just been richly educated today. Thank you, Wealth Advocates Nation. It's great to see you. We'll see you again soon.
Wealth Advocates is an SEC registered investment advisor. SEC registration does not constitute an endorsement of Wealth Advocates by the SEC, nor does it indicate that Wealth Advocates has attained a particular level of skill or ability. This material prepared by Wealth Advocates is for informational purposes only. It is not intended to serve as a substitute for personalized investment advice or as a recommendation or solicitation of any particular security, strategy, or investment product. Opinions expressed by Wealth Advocates are based on economic or market conditions at the time this material was written. Facts presented have been obtained by sources believed to be reliable. Wealth Advocates, however, cannot guarantee the accuracy or completeness of such information, and certain information presented here may have been condensed or summarized from its original source. Wealth Advocates does not provide tax or legal advice, and nothing contained in these materials should be taken as tax or legal advice. Please consult with your tax professional regarding your particular situation before implementing any strategies discussed. Advisory services are only offered to clients or prospective clients where Strategic Advocates and its representatives are properly licensed or exempt from licensure. No advice may be rendered by Strategic Advocates unless a client service agreement is in place. Strategic Advocates LLC is a registered investment advisor. Please visit our websites at www.wealth-advocates.com or www.strati.co for important disclosures. Securities offered through registered representatives of Creative One Securities, a broker/dealer, member FINRA/SIPC. Advisory services offered through Strategic Advocates LLC, a registered investment advisor. Strategic Advocates LLC, Wealth Advocates, and Creative One Securities are separate entities. Wealth Advocates is located at 255 South Main Street, Suite 140, Logan, Utah, 84321.